What is a stock? How does its price change? What are they useful for? Where can you buy them and sell them? In this video, I will explain all this and much more so you can start your way in this interesting world. Stocks or shares, as they are often referred to, are equal parts of the ownership of a company. The greater the ownership of shares, the greater control over the company and greater power over decisions. The shares give their holders right to the profits of the company, and in case of liquidation, to keep the remainder after having paid all the company's debts. Companies can create new shares that are sold in order to raise capital that they invest in expanding their operations, through purchase of equipment, facilities, and the hiring of new personnel. After issuing shares, the company is said to be public and shareholders can use the stock market to buy and sell their shares with other people. The stock market is a great ally of companies. If it were not possible or easy for people to sell the shares they bought, the money they will pay for them will be less and companies will receive fewer resources for investment. Once the shares are in the hands of the people, the purchase and sale of these does not generate new resources for the company, but a simple change of owners. In the stock market, the shares of all kinds of companies such as Nike, Ford, Apple, Coca-Cola, Boeing, Pfizer, Caterpillar, Procter & Gamble, ExxonMobil, among many others, can be exchanged. As in any market, stock prices change due to a force of supply and demand. Greater interest in a company will cause its price to rise, and less interest will cause its price to fall. These interests are given by the expectations that people have of the company. Therefore, a company like Tesla, which still does not generate net profits, has a market value similar to that of its competitors that generate billions of dollars in net profits per year. Thanks to the variation in their price, shares can be used to speculate and to invest. When you speculate in stocks, you seek, as with any other financial asset, to take advantage of the price movement to make a profit. When you invest, you seek to benefit from the company to which these shares belong and through the appreciation of its price and its dividends to obtain profits. The dividends received by the owners of a share represent the distribution of profits that the company generated during the last period. Companies that require less investment tend to pay out more dividends. Companies that pay less dividends tend to reinvest most of the profits in growth. Looking for more people to trade their shares, companies can divide them this way. A share that previously had a price of 1,200 is divided by 4 and each of these new parts has a price of 300. This is known as a split. The value that shareholders have of the company remains the same. The only thing that changes is the number of shares they have. Stocks are frequently grouped into stock indices. Indices are portfolios of stocks that allow you to invest in specific market sectors or in a group of companies in a country. The main stock indices are the SP 500 that tracks the behavior of the 505 stocks of the largest company in the United States. The Nasdaq that tracks the behavior of the largest technology companies in the same country. The DAX that follows the behavior of the shares of the main German companies. The Nikkei that follows the shares of the Japanese market, among many others that follow the behavior of the stock markets in the main economies of the world. There are also other indices such as the MSCI World that tracks the behavior of more than 1,600 stocks from around the world. Hope you find this video useful. If you'd like to see more videos like this, don't forget to subscribe and turn the notification on so you don't miss anything. Give it a thumbs up and share it with your friends. See you next time on another video about the stock market.